As one of Australia's leading ETF managers, we've seen it all. Today, we're going to break down the top 5 ETF myths we hear. Myth number 1, ETFs are a risky investment. The investment structure of an ETF isn't any riskier than investing directly in a stock or via a managed fund. ETFs cover all types of asset classes and exposures, from currency and commodities to fixed income and equities, and will be subject to different types of investment risk. It's helpful for investors to consider their risk profile when determining how to use ETFs within their investment portfolios. For example, an ETF holding 200 of the largest stocks on the ASX will have a very different risk level and volatility level than an ETF that tracks Australian bonds. Myth number 2, ETFs are priced like stocks and are illiquid. ETFs are traded on an exchange like stocks and shares, but unlike listed shares, on-screen volume is not an indicator of liquidity. When trading a share, liquidity is a primary concern, since you will generally want to buy or sell the share without pushing the price up or down. When buying or selling an ETF, the ETF traded volume is not a true indicator of its liquidity. ETFs are required to have market makers that are available to purchase or sell your units when you need to buy or sell. ETF issuers like Betashares are able to issue additional units or redeem units as demand rises or falls. That's why we say that the actual liquidity of an ETF is based on the liquidity of its underlying assets as opposed to the volume traded in the ETF. Myth number 3, ETFs create stock market bubbles. There's a claim often made about ETFs that they drive up stock prices regardless of fundamental value, and that this introduces volatility into the market. This would be a valid argument if ETFs accounted for enough of the stock market to have an impact on stock prices. Take the Australian Securities Exchange. The total value of the ASX stock market hovers somewhere around $2.3 trillion, and ETFs listed on the ASX account for around $131 billion. So, ETFs sit at only 6% of the overall value of the stock market. Even if ETFs behaved in such a way that could create a bubble, at 6% of the total market, all ETFs combined wouldn't be able to impact the ASX broadly. Perhaps even more importantly, is the only thing that is responsible for market volatility is investor behaviour. Myth number 4, ETFs are only for passive investors who want to replicate the market, not beat the market. Most ETFs are passive investments because they typically aim to track an index that has been constructed by an index provider such as S&P or MSCI. While these types of ETFs do not aim to outperform the indices they're based on, adding ETFs to your portfolio can give you access to asset classes that you otherwise may not have access to. When used alongside a broad market ETF, this could increase the outperformance potential of your portfolio over using a broad market exposure alone. Additionally, active ETFs exist too. Active ETFs usually seek to outperform the benchmark index or the broader share market. Myth number 5, ETFs are a fad. The argument that ETFs are in any way a temporary investment option is not supported by facts. ETFs have been around globally since 1990 and in Australia since 2001. The total amount invested in ETFs now sits at over $10 trillion globally and typically make up 1 out of every 3 trades on the largest stock market in the world, the New York Stock Exchange. Check out our Megatrends video on ETFs for more backstory on the growth of ETFs from humble beginnings to one of the most popular investment vehicles in the world. Thanks for watching. If you enjoyed this video, please like and subscribe and visit our website for all things ETFs, investing and portfolio construction. See you next time.